Hey guys, I'm finally back. I just finished my final exams and I have some time to implement a new idea which our editor Rupesh has pitched, which is going to be one company analysis possibly per week, which we're going to deep dive into the history of the company, the numericals, try to figure out the things which an investor should be looking for in those companies. And we're possibly going to pick up certain companies which you guys have been asking for quite a while. So don't think that we haven't been reading your comments. We have been reading a lot of your comments, and we do plan to pick up some of the companies that you have been asking for. And there will be some companies which we ourselves are interested in, which we want to do an analysis on and share with you guys. And it's going to be a good learning experience for me and my team. And I hope it's going to be valuable to you guys, the audience. And we're going to try and put out a company analysis per week, and we'd love your feedback on it. And if you do have any suggestions, you can leave them in the comments below. Again, I thank you for your patience and your support for this series, and not only this series, but for our channels. Thank you once again.
Hi everyone, welcome back to Beerage. Happy Saturday. I hope you're doing great. It's Saturday evening. Maybe some of you are planning to go out. Well, I just want to quickly talk to you before you head out or do anything else for your Saturday evening. I promise not to hold too much of your time. I'll try and keep it under 10 minutes. A lot of you were asking me about portfolio management. It's something that was asked in the group in Instagram, and then I spoke about it very briefly, but then a lot of you had replied in that answer saying, can you talk a little bit more about it? Of course, a lot of you wanted me to talk to you about this in Tamil. I'll try and talk about the same thing in Tamil on Instagram and put the video up there on the Reels probably. And you can see it there if you're interested in the same content in Tamil. Hopefully it will be done by now because this is Saturday now. And I'm recording this much earlier. It's recording it on a Thursday. So what is portfolio management? Portfolio management is nothing but portfolio is all your stocks and your debt and your bonds and everything put together is called your portfolio. Management is keeping it tidy. This is true for anything. If you have a house, you can call it house management. If you have a car, you can call it car management. It's nothing but taking care of whatever the management is required to be taken care of. So portfolio management is two words which come together, which means taking care of your stocks and your investments. There are basically four types of portfolio management which can be done. They're classified as that, depending on which way you go. One is known as active. In active portfolio management, what happens is a lot of churning happens, a lot of buying and selling happens. So-called profit booking is what this is where it comes from. When someone is actively managing their portfolio, that means they're constantly looking at the stock market for an edge, and they buy and they sell and they try and make a profit on these profit bookings. So let's say they buy it for 10 rupees. If the stock hits a certain price, they look at it, they sell it. This is where you see stop loss, or book your profits at a certain time. They'll make a call saying buy this XYZC stock at whatever rupees, and if it reaches a certain level, they say book your profits and exit. Or if it starts declining up to a certain point, they'll say cut your loss at this point, stop buying more of the stock at that point. So that kind of thing is where active portfolio management comes from. The second one is passive, is where I'm more leaning on. Passive is long term, where your idea of investing is in the long term. This is like what Warren Buffett and Charlie Munger and my brother keep saying, where you think of investing into a business, owning the business, being a partner in the business, where you're just not trying to make a quick buck, where you understand the business, you study it, you take time, and there's a lot of thought in it before you decide to invest. And when you do invest, you're looking at it for the long haul. Long haul is anywhere between 10 to 15 years. This is where a lot of ETFs are also invested. That will also, a lot of passive investors buy ETFs, like sectorially. If you're not able to afford a certain company, because IT stocks are all very expensive, so you can look at an ETF in the IT sector or the pharma sector. Same way, index funds also fall into this, because index funds are passively managed, they're not actively managed, so they fall into this kind of investing too. So most of passive investors, passive portfolio management, will have long-term stocks, will have ETFs, and will also have index funds in it. Then we have the third kind, the discerning investor or the discerning portfolio management. In this, what happens is you have a portfolio manager. You have a professional who manages your money for you. This is where high net worth individuals fall into. All your celebrities, all your Bollywood, Hollywood stars will all have someone who's a portfolio manager for them and who they trust 100% to manage all their money. Why do they have this? Because they do not know. They're busy doing whatever they're doing, creating the money and living their life. They can afford to have a person who they have on their payroll who will manage. And that person will decide based on the client, how much should be in safe, how much should be gambled with, and that's when you see a lot of churning happening in the market when these high net worth individuals move into a small cap stock and they're trying to pump it and dump it, and all these things happen in this realm of the world. I don't exist in this realm because I'm not a high net worth individual. I don't think most of my viewers are anyone of high net worth individuals or consider themselves high net worth individuals. Most of us are very conservative and we don't like taking these kinds of risks on board. The last fourth one is called the non-discretionary portfolio management style, where you have a portfolio manager who will suggest that he's called an advisor. He'll give you suggestions saying, I suggest you do this, I suggest you do that. But the investor, that's me, I decide what I want to finally do with it. So that is known as non-discretionary. And most retail investors will fall into this category in India because we all have many advisors suggesting on social media, on non-social media. Your friends, everybody will be telling you, advising you what to do, what not to do. And then end of the day, you'll go log on to your monitor and you'll decide what you want to buy or not buy. So retail investors fall into this box. Now, there are some key elements in all four of these to take into consideration. One is asset allocation. No matter where you are, whichever you fall into, what you should keep in mind in is asset allocation. The assets which are available for you to invest are stocks, bonds, and of course gold. Stocks, bonds, and gold is what you can invest in terms of asset allocation. So that is something you should consider. Why should you consider that? Because it is to reduce your risk. Depending on how much risk you're willing to tolerate, you should adequately adjust your allocation of assets. That is part of the portfolio management. The other is known as diversification. Diversification is within each. You have various types of risks which you can diversify to mitigate that risk, such as investing in different sectors in equities, different sectors in bonds. So that way you lower your risk. So you're more risk averse. Or if you like risk, you can try to put all your eggs in one basket. That is part of portfolio management, which you have to decide. The third thing is risk management itself. When I say risk management, is keeping track of all macro news like the dollar, the rupee, what is happening with the gold, what is happening in the US in terms of Fed and their policies, what's happening in terms of RBI and its policies. Then, of course, keeping an eye on all the stock news and market news, the FIIs and the REIs, what they're doing. All that falls into this kind of risk management. And the last is rebalancing. Rebalancing is an important facet of portfolio management, no matter which way you go. That is, as you grow old and as time moves on, your goals in life keep changing. It happens to all of us. All of us, when we were small, we wanted to be an astronaut, we wanted to be this or that. As we get older, those dreams turn into something else, and we all end up being somewhere else. Same way, your goals in life also keep changing and moving along. So you should also be adjusting that accordingly. The second reason you need to adjust is market conditions always keep changing. Companies' conditions keep changing. So you need to always reevaluate and readjust. For each style, there's different ways to adjust and evaluate. Some of them do it yearly. Some of them do it, semi-annually. Some of them even do it quarter-wise. So it depends on which way you would like to go. You can do rebalancing. And the last part of portfolio management is equal and unequal. Equal is being unbiased towards all your stocks and equally allocating to each one of the companies you're looking at. So let's say you have a list of 10 companies, you divvy out equally to all 10. Like I spoke about that 4 crore video in 15 years reaching 4 crores. In that, I divvied all the money every month equally into 10 companies, and then I became 4 crores in 15 years. So that is an equal. But the problem in that is the upside is limited. Meanwhile, the unequal side is to maximize returns. And what you do in unequal is you try and analyze each company which you want to invest in, those 10, and you see if it's the right time to invest. If it's the right time to invest, you put more money in that. If something is not looking so great right now, you invest little less in that. So you kind of like unevenly invest based on your analysis of each company, which will give you better returns in the long term. That's what Anand keeps on saying. Entering the company is very important. But there is risks involved in it. You may enter the wrong time. Your analysis might be wrong. So that is the counterpoint to having an unequal portfolio. So you depend on your analysis of the stock. That's why I keep saying just don't rely on my analysis or Anand's analysis. Please do your own analysis, especially if you're doing unequal portfolio management. Allocating your funds depending on what you think is the right stock today. Like today I should buy gold or today I should buy whatever. So keep that in mind. This is what basically portfolio management is. I think I've covered most of it. If you think I left something out, put it in the comments below. I'll try and come back to it and talk more about that. Or other people can also read and have a conversation there. That will be even more productive than me doing another repeat video on the same topic. If you'd like this kind of conversations, we do have them mostly every day on the Instagram channel, which I'm sitting with all of you who participate. I do meet some of you in real life out in Chennai here and there when I'm out for coffee. So it is really nice to bump into some of you and have conversations too. Have a wonderful Saturday evening. Do stay safe out there. Nothing else more to say. See you tomorrow, Sunday evening, with something else. I think tomorrow I'm going to be talking about bonds, maybe. See you tomorrow. Take care. Bye.
Hey guys, that my uncles VinodSrinivasan, AnandSrinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.